Do you work for an employer that provides you with restricted stock units or RSUs, and you have no idea what to do with this type of compensation? Hi, my name is Zach Morris with Paces Ferry Wealth Advisors, and I want to talk to you about restricted stock units and how this type of compensation might affect your financial plan and what might be an effective strategy for you to realize this type of compensation. Most of the time, RSUs are very similar when you work for a publicly traded company. Now, if you work for a private company, this advice might not apply because there are some nuances among private company restricted stock. However, restricted stock units, which we're talking about today, or RSUs, if you work for a public company, most of this advice should probably apply. Now, you should always check with a qualified tax advisor before implementing any sort of tax advice. The first thing I think it's important to understand four different terms, and don't be frustrated if you don't understand these terms right off the bat, because I'm going to use them again in my explanation. The first one is cost basis. So cost basis is essentially what you pay for something. So if you buy stock for $100,000, that's your basis. If it goes to $110,000, that's a gain. All right. The other term I want you to understand is holding period. So if you buy a stock for $100,000 and you hold it for 1 day and sell it for $110,000, your holding period is 1 day. If you buy a stock for $100,000, again, to use the cost basis term, your cost basis is $100,000. If you hold it for 365 days, your holding period is in 365 days. You sell it for $110,000, your cost basis is $100,000. The sale price is $110,000. You then realize $10,000 worth of a long-term capital gain. The other term that it's important to understand for understanding your restricted stock units is substantial risk of forfeiture. So if something's at substantial risk of forfeiture, you haven't actually received it. In the eyes of the IRS, if it's at substantial risk of forfeiture, you don't have to pay taxes on it because you're still at risk of losing it. What I mean by this is that if you're granted a restricted stock unit and it's still at substantial risk of forfeiture, in other words, it hasn't vested yet, then the IRS is not going to charge you taxes or make you recognize any type of income until that stock is yours, until it has vested. So now the next term is vesting. If you're given a grant of RSUs, they may not be yours yet. Right? And since they're not yours yet, they're still at substantial risk of forfeiture. So because they're at substantial risk of forfeiture, if you are fired from the company or you leave on your own will, or the company goes out of business, it's possible that you don't get to realize that benefit. The vesting schedule that's given to you when you're granted RSUs is typically going to be a number of years. A 3-year graded vesting schedule, a 4-year graded vesting schedule. This means, let's use the example of a 3-year vesting schedule, that if you're given $100,000 worth of RSUs today or 100,000 shares, you might get 33 shares in year 1, 33 shares in year 2, 33 shares in year 3. The next term that I'm going to use in this video is net vested shares. The net vested shares is the amount of shares that's given to you at the time of vesting that's net of the shares that are withheld. So typically, companies are going to withhold 25%. So if you have 100,000 shares that are vesting, they might withhold 25,000 shares and deliver to you 75,000 shares. That's your net vested shares. Now that we understand the terms that I'm going to use in this video, let's talk about the taxation of your RSUs. When your RSUs vest, you realize income on that day. Let's use an example of a gentleman named Frank. Frank works at ABC Company and he has 30,000 RSUs that were granted to him on the day he started. They're on a 3-year graded vesting schedule. So each year he's going to get 10,000 shares that are going to vest on March 15th. On that first vesting date, the company is going to withhold 25% of his shares and deliver to him 75 shares. So remember, he's getting 10,000 shares on that vesting date. Okay. The company is going to withhold for taxes. They're going to withhold 2,500 shares. So he's going to get 7,500 shares delivered to him on that date. Now, when he receives those shares, that 10,000 shares is considered 100% compensation to him. It's going to show up in box 1 of his W-2. So if you remember receiving your W-2, and I'll flash it up on the screen here for you, it says wages, tips, and compensation, right? That's where your RSU vesting is going to show up. So it's no different than any other compensation that you receive on that day. Now, 100% of that is going to show up under wages. So 10,000 shares worth, let's just say for the sake of this example that it's $1, right? So he's going to get $10,000 worth of income that's going to show up on his W-2 for that vesting. On that day, he receives 7,500 of what's called net vested shares. So remember back to the net vested shares is the amount of shares that he's going to receive after the company withholds for taxes. Okay. His cost basis on that day is $1. So each share is worth $1 on that day. And so he's going to receive 7,500 shares at $1 value, and that's his new cost basis. Okay. His holding period is going to be 0 days, technically. 1 day from that point, it's going to be 1 day. However, if Frank were to sell those shares on the day he receives it at $1, he will realize no additional income at the end of the year. I'll say that again. If Frank sells those shares at $1 when he receives those net vested shares, he won't realize any additional income than he's already received from that vesting. Now, the common misconception that we see is people have restricted stock, it vests, they get what's called net vested shares delivered to them, and then they hold on to it for a long time because they don't realize that if they sell it at that time, at that price, that it's not going to be an additional tax liability. They're not going to create an additional gain or additional taxes owed by selling it on the day that it vests. So typically, our advice, not always, but typically our advice is going to be to sell those shares as they vest. And here's the reason why. If you work for that type of company, it's a good chance that that vesting is just one of many that's going to come. And maybe you have a vesting in March, but in April, you're going to get more compensation in the form of more shares. So the longer you work there, the more and more you're going to get tied to your compensation is going to get tied to the performance of this company. If you never sell those shares, as time goes on, you can build up a concentrated position in this company, which would have a tax liability if you were to try to get out of it and lower your concentrated position. Now, a concentrated position isn't always bad. Warren Buffett says you build wealth through concentration and you preserve it through diversification. However, if you keep going long enough and just receiving these net vested shares and letting that stock position build up, well, now your financial plan is really beholden to the performance of this company, right? So typically we don't think it's a good idea to have more than 10% of your net worth tied up in this company. So let's look at this from a different angle, because I think it's important to understand that if you hold the stock at the time of vesting, so remember, at the time of vesting, you're resetting your cost basis. At the time of vesting, you're resetting your holding period. So your holding period is 1 day, and your cost basis is whatever the stock was at when it vested, right? So it's as if you're getting a cash award that day, and you're turning around and buying the stock for whatever price it is at that day. So if that's your intention, then it's okay to hold the stock. If that's what you wanted to do, then hold the stock. And then my advice is you probably don't want to have more than 10% of your net worth tied up in any single company, whether you work there or not. But if that's not your intention and you needed that money for whatever it might be, for spending money, or you needed it to, or you wanted to invest it in a diversified portfolio, then that's where my advice comes in to sell it as it vests. Now, let's say you didn't want to sell the stock because you thought it was going to be going up. All right. So let's use $7,500 as an example. If it goes up to $8,000, You're going to sell it and you're going to pay short-term capital gains on that $500 difference. Okay. However, if it goes down and you have to sell it for $6,000, you're only realizing a benefit of $6,000. However, when you got those net vested shares at $7,500, you got a benefit of actually $10,000. You paid tax, so you got $7,500, and now you're only realizing a benefit of $6,000. So you're paying tax on a benefit of something that you never received, right? So holding that stock for any amount of time runs the risk of the stock going down, whereas you already paid tax at a higher price. Now, the net vested shares issue is something that a lot of people run into, and they get surprised in April when they realize that they have to pay a lot more taxes than they thought they needed to. The reason for this is that most companies withhold and deliver net vested shares based on 20% or even 25% withholding. However, if you're in a 37% tax bracket, there's a good possibility that the company is under withholding on your net vested shares that are delivered to you. So you can do one of two things. You can contact your HR department and you can ask them to increase your withholding on your vesting so they can withhold more shares. If you've already built up a concentrated position in the stock, this is a great way to minimize the amount of stock that's going into your account because they're going to use more stock to pay for your taxes. The other strategy is that you could just increase your withholding. You could change your settings in your payroll system so that they think you're filing married filing single or just single. You could decrease the number of dependents that you have. Any of these steps, and of course you want to do this in conjunction with your CPA, but any of these steps can help to have your payroll withhold more taxes throughout the year. The last possibility is that you can work with your CPA on a quarterly basis to make sure that your estimated payments are enough to cover what wasn't withheld in your stock vesting. This strategy, of course, could have you paying more taxes than you actually need to in order to avoid penalties. However, some people prefer not having a big tax bill come April. Now, some reasons that you might not want to sell the stock when it vests is that you might be subject to certain holding requirements. So certain executives are required to hold 1 times their salary or 2 times their salary in the stock. If that's the case, you want to make sure that you reach that threshold, that you meet that holding requirement before you start selling restricted stock. The other reason why you may not want to sell it as it vests is that you may be subject to blackout periods. So certain insiders may be subject to what's called material non-public information, or they may be considered a Section 16 insider. If this is the case, there are strategies so that you can sell net vested shares as they vest. However, that's not going to be covered on this video. Please send me a message and we can talk about how you can set up what's called a 10b5-1 plan. And that will allow you to sell shares while you're still in a blackout period. So in summary, the typical recommendation of selling as your stock vests are for a number of reasons. One, you don't want to build up a concentrated position in a stock that may end up being a big part of your total family's net worth. Selling as it vests helps to mitigate this single stock concentration. The second reason is if you've gotten grants when you started working there, there's a possibility that you're going to continue to get compensation in the form of RSUs. And so selling as it vests continues to help mitigate that concentration build. The other reason why you might want to consider selling your stock as it vests, your RSUs as they vest, is that you're paying tax on it when it vests. So that amount is going to hit your box 1 of your W-2, and it's essentially classified as income. So your cost basis is set that day. Your cost basis is set at the day that it vests. Your holding period is reset at the day that it vests. So again, going back to the earlier example, the stock was at $1 when it vests. Your cost basis is now $1. So if you sell it at that time, You're not going to pay any additional tax in that sale as long as you sell it at that $1 price. If you enjoyed this video, please subscribe below, and please be on the lookout for other financial planning topics on this channel. Thank you.